Welcome to Dr. Fred Markets. This is not financial advice. Every day, the world of finance, crypto, and artificial intelligence moves fast, really fast, and staying informed is the only way to stay ahead. That's exactly what we do here, together. Let's get into today's video.
Wall Street is sleepwalking into a blue-collar bull market, and you're missing it. Signal 1. The S&P just dumped 2.5%. Nvidia is down over 6%, and every tourist investor is screaming recession and hugging the same 10 mega-cap tech names like a security blanket. Signal 2. At the exact same time, the Wall Street Journal is quietly running a piece saying the U.S. is desperate for mechanics and electricians, and big business is literally paying to manufacture them because they ran out of skilled hands. Signal 3. Apprenticeship programs for trades are up double digits over the last decade, and completion rates are rising, while half the college kids wander into useless degrees and debt traps. Yet most portfolios have zero direct exposure to the companies minting cash from this boring labor crunch. Here's the cliffhanger. Everyone cries about AI taking jobs, while the real money is in trades that AI can't touch without a wrench, a ladder, and a union contract. Here's the connection you're not supposed to see. Every time a country runs short of skilled, physical labor, wealth doesn't vanish. It flows to the people and companies that own the bottleneck. Today, the bottleneck is not coders. It's the people who keep the electrical grid alive, fix planes, maintain data centers, install EV chargers, and wire factories. AI writes code. It does not crawl into a turbine at 3 a.m. and stop the city from going dark. So when big corporations start funding trade schools and apprenticeship pipelines, that's not charity, that's vertical integration of labor. They realized replacing one senior electrician now costs more than replacing an entire middle management layer, and they're locking in supply like an oil major locking in a field. You want a number you can taste? Construction job openings hover well above pre-pandemic levels. Manufacturing is still short hundreds of thousands of workers, and infrastructure spending is locked in for years thanks to government bills already signed. That spending goes into hands-on work, wiring, welding, HVACs, heavy equipment. No prompt engineers on a cherry picker. Now mash that against today's tech tantrum. When Nvidia pukes 6% in a day, passive index zombies get punched in the face because their diversified portfolio is just a handful of AI names in a trench coat. Meanwhile, the companies that depend on real-world muscle to keep their factories, warehouses, and data centers alive are staring at the same problem. Too few people who know which wire not to touch. Here's the single thing you learned today.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
Labor shortages in non-automatable jobs function like a pricing power engine. When you can't replace the worker, their time, and the companies that productize that skill get a structural raise. Not cyclical, structural, mechanism time. Step 1. Wages for scarce trades ratchet higher because projects literally cannot proceed without them. Delay penalties on a big industrial project dwarf the cost of higher pay, so companies cave. Step 2. Firms that run training, certification, or staffing for these trades start earning annuity-like revenue. Recurring training contracts, placement fees, ongoing service agreements. Step 3. Automation and AI. Instead of replacing these workers, increase the premium on the remaining humans who can supervise, repair, and integrate machines into messy reality. You don't buy plumbers as a stock. You buy the infrastructure ecosystem that monetizes their scarcity. Industrial training companies, staffing firms overweight in skilled trades, tool and equipment rental chains, specialty construction and maintenance outfits with long-term service contracts. The market still prices a lot of this as low-growth sludge while praying at the AI altar. Here's what this means for you. You stop asking, will AI kill jobs? And start asking, which jobs does AI absolutely suck at, and who profits from those staying scarce? You front-run the re-rating of blue-collar scarcity before Wall Street writes a white paper and slaps a buzzword on it. 3 moves, no fluff. 1. Audit your portfolio for tech worship. If your future depends on 10 AI names not tripping at once, you're not diversified, you're leveraged to one story. 2. Research listed companies that earn from training, certifying, or deploying skilled trades, especially those tied to infrastructure, EV build-out, and data center maintenance. Look for long-term contracts and rising margins, not hypey narratives. 3. Zoom out 5 years. Every data center, EV charger, substation, and factory line the AI boom demands will need electricians and mechanics on the ground. Own the backbone, not just the brain. This is not financial advice, but it is the truth. The next quiet bull market sits in the hands of people who still get dirty at work while everyone else argues about whose AI prompt is prettier. If you learned one real thing today, subscribe. Tomorrow we open another vein. Wall Street is too snobby to touch. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.